I suppose what we all want to know is a frenzy of activity in perhaps one of the most volatile periods in living memory. What are the clients doing now? Are they still actively trading? Is there still that sense of frenetic energy from the client?
Thanks very much for having me. Yes, this has been a very interesting and a very animated first half year, obviously. Clients have been extremely active in the market, but not just during the peak period of March and April. We've actually seen continued client activity throughout the entire half year with a bit of on and off. But coming out of the first into the second half year, I still sense there is a lot of dynamic as clients are looking what are the markets doing, how are now those recovery patterns happening in the different countries. And it's going to be interesting moving forward.
When I look at the Treasury book, and that's how you just chatted me before you came in and said, look at the FX, the derivatives and the metals book, that's £500 million Swiss francs. My question is that hedging or is that actual active client engagement? How would you define that kind of number in the report?
Obviously, in our balance sheet, there are two kind of activities. On the one side, there's the Treasury book, and the Treasury book has been revalued with the huge change in dollar interest rates throughout the first half year. But obviously, on the other side, on the trading side, we've been benefiting from very high client activity throughout that period, which is reflected in the numbers.
And the guidance going into the second half of the year, are you going to need exceptional volatility again to deliver these kind of numbers and margins?
I think obviously volatility helps, and this is a business. We are a business model that can capitalize on volatility, as we have proven. And I think we're going to have it. We're going to have it obviously from a market perspective. There's going to be stimulus in the market. There's going to be political uncertainty. So I think there are a few ingredients in the second half year that can truly drive volatility.
Is it the US election that's perhaps the biggest risk for you?
It's obviously one of the risks, but not the only one.
The other dynamic is this. We look at this amazing recovery in equities, the change in credit spreads. Do you think there's a certain amount of detachment from our markets from reality?
That's very hard to comment. I think obviously, in reality, in the real economy, the impact of the crisis is going to play out over a longer period of time. In the first half of this year.
Do you think we're underestimating the length of time this is going to work out over?
Maybe, but I think what's very hard to predict is really the recovery patterns. And I think those countries that have taken measures early and in a thorough way and in a deep way, they will see faster recoveries, whereas other countries will be in for a much longer game.
Now, you talk about the digital client connectivity and remote working solutions. What's realistic here? Is this about, because I know you're on a journey of transformation in the bank, so is working from home, what percentage of Julius Baer can work from home?
Had you asked me at the beginning of this year whether so many people could work from home, I probably would have said no. 3 months later, we had almost 7,000 people enabled to work from home. And in some of the offices, we had over 90% of staff actually working from home and doing so productively. So this was quite amazing. Looking forward, I think this is not going to stay there, but we will have the opportunity for almost a new balance between physical presence and remote working, direct communication and digital communication.
Do you think that's 10%? I mean, look, obviously we're trying to get a number. UBS, the CEO, I think, said 30% can work from home. But in your model, you've got to downsize the bank. You've got to radically get a hold of costs. So will the work from home be part of that?
I'm not sure if I look at it from a cost perspective. I really look at it from a client perspective first. For example, in a client meeting a year ago, it would have been unthinkable to have an expert digitally at the table on the iPad. Today, it's completely possible. That gives new ways of interacting by not having physical presence mandatory. And then obviously, I think in different departments, the ratios will look different. And I'm very sure that we are using this new technology possibility and cultural element to the maximum forward.
If we just translate that back into cost, if I look at what Facebook are prepared to do, Zuckerberg says, look, I'm prepared to look at people in different locations and pay them different amounts of money. That's surely appealing, isn't it, as part of a strategy for you?
That's not a very new concept, isn't it? I think
no, but the spread that you have of private client advisors around the world will give you a little bit more dexterity, won't it?
I do think that the localization of advisors is an important element. That has always been an important element for us in our global business model, to have the advisors in relative proximity, at least within the areas of where our clients are, and that's not going to change. Obviously, what we can do is have much more exchange in the back part of the value chain.
Now, obviously, Latin America has been a slightly cantankerous area for you to deal with the regulator, but part of that is you're not able to do transformational deals. And the question that comes to my mind, do you feel boxed in because of that?
Actually, no, we're not boxed in. I think we've been set out on a very clear path to implement our strategy in February, shifting our focus to sustainable profit growth, sharpening the value proposition for our clients and taking investments in people, but also especially in technology, which we've even accelerated. I think this is a good time to do that, and we're fully focused on this. We are able to take smaller transactions at this stage on a country-by-country level, and by the time the restrictions will be lifted, and I'm very sure they will be lifted throughout next year, for larger transactions, we will be ready for that.
Okay, so you think the penalty for larger transactions will be gone, what, by the end of the first quarter?
Hard to predict the timing, but I hope it's next year.
Okay, so you say that you are prepared to look at smaller deals. Where appeals?
Obviously, in all our core markets. We set out on a number of core markets across the globe. You mentioned Latin America, Brazil, Mexico, but obviously here in Europe, we have a number of real core markets, starting here in Switzerland, but taking Germany, taking the Iberic part. Asia, Hong Kong, Singapore, very important. Those are the places where we want to continue to grow.
I noticed the net new money actually popped higher. You specifically talk about Hong Kong and Japan. What about the flow of money from Hong Kong as a result of the dislocation, the political dislocation in Hong Kong at the moment?
There has not been a direct correlation to that. I think we've seen continuous flows in Hong Kong. Hong Kong is one of our most important hubs in Asia. Asia is our second home market, and we will continue to invest there.
Onshore in China, is that going to be the hallmark of your tenure?
Well, you're now thinking one S-curve beyond. But
well, I like to think that you're going to be here for a while. But is that an ambition to get onshore in China?
Obviously, we're always looking at our geographic footprint. It's important to be in the places where growth is. Right now, we're in Hong Kong, and we're there very strong.
The other question that everybody wants to know is, how do you deal with Latin America? Again, I noticed the net new money turns positive in Latin America. But if we look at the problems that you've had there, what are the choices? Close, right the ship, or sell it?
I think for Latin America, we've been committed to the region. We continue to be committed to the region. We have two very strong core markets in Latin America. That's Brazil and Mexico, where we have an interesting combination of an offshore business, a Swiss-led offshore business, but on the other side also a very strong onshore presence. JB Family Office, we just integrated a GPS and Reliance into JBFO in Brazil. And so we make important steps to invest and to consolidate our footprint in those core markets.
Philip, it's a market show. Anna and Matt are sat in London. We've got a global audience. The biggest risk going into the second half of the year, what do you think it comes from? Negative rates, politics, China? What is it that goes through your mind?
I do think we're going to see uncertainty, and I think the uncertainty lies in the speed and in the depth of the recovery patterns. Where does it happen and when? I think that uncertainty is obviously a big risk, and then a bit of overlay obviously from what's happening politically. But I do think we continue in a volatile situation, and it's good for those players who can capitalize on volatility.
How destructive would negative rates be in the United States of America, do you think, to markets?
Well, I'm not an economist. I can take it here from a Swiss perspective. I do think negative rates, obviously they have been a necessity, but negative rates do have a number of implications and create collateral damages, for example, to the long-term pension system, and that is not to be underestimated. I do not think they're a recipe for the long term.
So if I look at the 10-year, Colladi was the growth booster. Hodler, I would say, was a very stoic captain. I've interviewed him as well. What is the hallmark for you? What do you want to do in the JB seat when you're here?
We really set out to reinvent wealth management when we came here at the beginning of the year and talked about our new strategy and sort of coping with the new challenges, changes in margins, changes in the business dynamics, and making sure that wealth management is even more relevant for our clients in the next decade than it was in the previous decade. I do think we have that fantastic opportunity. We have a great team. Julius Baer is a fantastic firm with almost 7,000 employees that have shown their resilience, but also their dynamic and innovation capability in the first half year. I see myself as part of the team and working together with the people to actually deliver on that promise, and looking forward to doing that.